Welcome to the Northbound Wealth Podcast. All opinions expressed by me, my co-hosts, or my guests are solely our own opinions and do not reflect the opinions of Northbound Wealth Management. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, and tax advice or as a solicitation to offer or buy any securities. Clients of Northbound Wealth Management may maintain positions in the securities discussed in this podcast. Hello, everybody. This is Brent Foster, the Northbound Wealth Podcast, weekly market insights. Today is May 13, 2024. Stocks rise, anticipating rate cut. So stocks notched a solid gain last week as rate cut expectations placed the rally as the Q1 earnings season wound down. So Monday opened with stocks picking up where they left off the prior Friday. Stocks were still basking in the afterglow of fresh jobs data, which eased investor concerns over an overheating economy. That and other reports of a possible Middle East ceasefire fueled Monday's rally. So stocks hung out in a narrow trading band Tuesday and Wednesday, yawning at the sparse economic news and a handful of negative earnings results. By contrast, the NASDAQ edged lower over those 2 days. On Thursday, the S&P 500 closed above 5,200 for the first time since early April. The next day, stocks rallied and the Dow clinched its 8th consecutive day of gains, the longest winning streak since December and its best weekly performance this year. Fresh data showed consumers continue to have inflation concerns for the year ahead, which was unsettling. So on the blog, on the website, www.northboundwealth.com, we got Y charts, weekly market insights. You can take a quick look at that major index return summary. So what we do is we summarize the Dow, the MSCI EAFE index, NASDAQ, and the S&P 500, as well as the 10-year Treasury note. And so here we go. So year to date, Dow Jones Industrial Average is up 5.15%. MSCI EAFE index is up 5.94%. NASDAQ Composite is up 9.14%. S&P 500 is up 9.83% on the year. And the 10-year Treasury note, let's see, the latest value, 4.50%. So about a month ago, it was sitting at 4.55. About 3 months ago, it was at 4.17. And about a year ago, it was 3.43%. So we're up on the 10-year Treasury note, and equities are hanging in there across the board on these indexes. So what's very cool to look at is the S&P 500 or over the past 1 year trailing number. So a year ago is up 28.57%. The NASDAQ is up 35.28%. International markets or the EAFE index is up 12.36%. And then the Dow is up 19.83%. So a lot to write home about. Good market performance always makes us feel a lot better when we see our 401ks, our IRAs, our investment accounts increasing in value, especially if they're allocated appropriately. If they're not, then give us a call and we can chat about it. About your unique situation, 317-399-1107. All right, so let's take a look at the economy and some other things that of note. So jobs data from the past few months have shown unemployment levels remain low while job growth remains strong, but not too hot. Okay, and the last week's Conference Board's Employment Trends Index for April projected slower jobs growth in the second half. The markets all year have responded well when the Goldilocks outlook suggests that economic indicators are just right. Let's see, key economic data that we're looking for this week. Monday, the Fed official Loretta Metzger speech. We're going to pay attention to that. Tuesday, Producer Price Index and the NFIB Small Business Optimism Index. Wednesday, Consumer Price Index, which we'll really pay attention to, and retail sales, business inventories, and another Fed official, Neil Kashkari, he speaks Thursday, housing starts, jobless claims, industrial production, import and export prices, Fed official speakers Harker and Bostic are both speaking. And then Friday, leading indicators. They're kind of coming out of this blackout period where they didn't do a whole lot of talking. Now they seem to, we call them Fed heads, kind of like deadheads, but for federal government guys. Fed heads are out. And I wish they weren't as big a part of the market conversation as they are. So hopefully that can subside when things shift in November. Okay, notable companies reporting earnings this week. The Home Depot on Tuesday. That ought to be interesting because I was actually just at Lowe's and man, everybody's there. I know Lowe's isn't Home Depot, but there's a lot of people out. Spring is in the air. Home remodels and construction projects are ramping up. So hopefully we'll get some guidance and see through to what Home Depot says the rest of the year is going to be looking like for them. And if they do well, then that means the consumer will do well. That means things are looking good. Wednesday, Cisco Systems. Thursday, Walmart. That'll be another one to pay attention to see how Walmart is doing at mass consumer and see how they're performing. Applied Materials as well as Deere and Company. So Deere and Company will indicate how the farming and big farming businesses are doing. All right. Tax tip of the week. Are Social Security benefits taxable? If you receive Social Security benefits, you may have to pay federal income tax on some of these benefits. Your payment will depend on your specific income and filing status. To find out whether your Social Security benefits are taxable, if you are single, take half of the Social Security money you receive throughout the year and add it to your other income, including pensions, wages, interest, dividends, and capital gains. If the total for the individual exceeds $25,000, part of your benefits may be taxable. If you are married filing jointly, take half of the Social Security money you receive throughout the year plus half of your spouse's Social Security benefits. Add both amounts to your combined household income. If the total is over $32,000, part of your benefits may be taxable. The IRS's website delineates the taxable percentages of benefits based on the above calculation. These percentages vary between 50% to 80% and depend on your filing status and income levels. For example, if you are filing as a single person with $25,000 to $34,000 income, 50% of your Social Security benefits may be taxable. The interactive tax assistant on the IRS.gov website can help you determine whether your Social Security benefits are taxable and, if so, by how much. As a reminder, this information is not intended to be a substitute for specific individualized tax advice. We suggest that you discuss your specific tax issues with a qualified tax professional. And this tip was adapted from irs.gov. On to the next segment. Stay tuned. Hello, everybody. In this segment, I'm going to cover an article in the Wall Street Journal. Wall Street turns up the heat on companies to perform. Shares of Starbucks, Five Below, and Netflix slid after they reported earnings. This article was written by Hardika Singh and published on May 12th, which was yesterday. And I picked this article up, read it, and I thought, you know what, this is a good one to share with everybody. So here we go. Let's dive in. Wall Street is showing little patience for companies that don't live up to expectations. And she's actually exactly right, you guys. With the first quarter earnings season nearly over, companies in the S&P 500 are on pace to deliver a 5.4% jump in profits from a year ago, the biggest increase in nearly 2 years, according to FactSet. But those that fall short of investor forecasts are being punished more heavily than usual. Shares of companies that missed estimates have slid an average of 2.8% compared with the 5-year average of 2.3% decline. Meanwhile, companies that outperform aren't being given any special prizes. Those that beat analyst forecasts have seen their shares gain an average of 0.9%, roughly in line with the 5-year average of a 1% advance. That is according to FactSet data that looked at share prices in the 2 days before companies reported through the 2 days after they reported. The market won't ask questions. It will just reduce valuations really quickly if you do not perform, said George Goncalves, head of U.S. macro strategy at MUFG Securities Americas. Companies are given little room for error in part because stocks look pricey, especially in light of the lingering uncertainty about whether the Federal Reserve will cut interest rates this year. Starbucks, for example, was among those that suffered repercussions for disappointing investors late last month. The coffee chain pledged to speed up service and roll out new drinks after a sharp slowdown in visits hit its sales and profit. Shares, nevertheless, sank 16% the day after it reported results and are still down almost 14%. Discount retailer Five Below's profit fell short of Wall Street's forecast despite another quarter of strong sales growth as it invested in curbing theft through measures like beefed up security. Its shares tumbled over 15% the day after it reported results in late March, and the decline has deepened to more than 30% since the results. I mean, that's quite a shellacking right after earnings. In other cases, companies are being punished even when beating expectations. For example, Netflix last month posted sales and profit that came in above forecasts, boosted by a surge in new customers. But the streaming giant gave a softer than expected revenue outlook for the current quarter, and its shares fell 9.1% the next day. The stock has since recouped most of its losses. Netflix is a hot stop right now. Let's see. The high bar for companies this earnings season reflects investors' nerves over stocks that are richly valued. The S&P 500 is trading at about 20 times expected earnings over the next 12 months, above its 10-year average of 18. The prospect of persistently high interest rates, meanwhile, has lessened the appeal of stocks relative to bonds while raising the possibility of higher borrowing costs for companies. The S&P 500 remains 0.6% off its record high in March. The benchmark index advanced 1.9% this past week, boosted by more recent signs of an economic cool down, and is up 9.5% for the year, thereabouts. The 10-year Treasury yield, a key driver of mortgage rates and other borrowing costs, was at 4.5% Friday, which, by the way, these comments here are supporting just some of the things that I'm sharing with you in my own view. So that was up from about 4.18% seen at the beginning of March, but it's off its 2024 high of 4.71% in late April. And here's a quote by Tim Hayes. He said, "The market has to reset expectations." He's the chief global investment strategist at NDR, which is Ned Davis Research. "There's maybe a little more realistic view of where things are going, realistic on what the earnings can be." Hayes said that the shift on rate cut expectations will step up pressure on all sectors to deliver spotless results, not just the Magnificent Seven group of tech stocks that have powered the S&P 500's earnings growth over the past year. For now, tech stocks remain in the driver's seat, with 6 of the Magnificent Seven companies having reported first quarter results. Earnings for the group are expected to surge 48% compared with a decline of 2.2% for the other companies in the S&P 500. According to John Butters, senior earnings analyst at FactSet, and Mr. Butters is very good at what he does. I follow his stuff. The S&P 500 communication services sector is beating Wall Street expectations by the second biggest margin, boosted by shares of Alphabet, Netflix. But the information technology sector, which holds Apple, Microsoft, and NVIDIA, is beating earnings projections by the third lowest margin out of the index's 11 sectors. Don Nesbitt, a senior portfolio manager at FM Investments, said that is worrisome because tech stocks account for about a third of the index's returns. That's where we see a lot of risk right now, Nesbitt said. This article, well done by Hardika Singh. Well done. And I hope you guys enjoyed this weekly market insights, Northbound Wealth Management. If you have any questions, please reach out. Here's a financial update. The Federal Reserve is holding steady on interest rates, keeping them at a range of 5.25% to 5.50% as they continue to grapple with inflation. Here are the key takeaways. The Fed isn't planning to reduce the target range until they're confident inflation is substantially or sustainably moving toward a 2% target. The central bank is easing the pace of balance sheet reduction, which could be seen as a slight loosening of monetary policy. High inflation and slow growth are raising concerns over potential stagflation. Expectations for rate cuts have shifted dramatically this year, with just one predicted for the end of the year. So what does this mean for you? The unchanged interest rates means borrowing costs remain high, which could impact consumer spending and the overall economy. The Fed's cautious approach signals uncertain economic times ahead, which may call for a more defensive investing strategy. High inflation could eat away at your real returns, making it crucial to consider inflation-protected investments. Stay tuned for more updates and keep these points in mind as the year progresses. And you can always reach out to Northbound Wealth Management at 317-399-1107. Considering a home improvement project this spring, one option for paying for the project is a HELOC, or a home equity line of credit. Unlike home equity loans with fixed interest rates, HELOCs can offer variable rates that may adjust over time. HELOCs also offer flexibility. You can only borrow you only borrow what you need, and you only make payments on the money that you've borrowed. Many factors need to be considered before creating a HELOC. Understanding the benefits and limitations are the first step. A financial professional may be able to help provide some guidance or offer some material that has insights. A lot of times, home equity lines of credit are offered by a lot of banks and credit unions and things like that. So there you go. There's a spring tip for you, and stay tuned for the next segment. Hey everybody, I just read an alarming article about a new robocall scam known as the, quote, "can you hear me," end quote, scam. Here's what you need to know. The robocall begins with a lifelike conversation, making it difficult to recognize that it's a recording. The scam tricks you into saying, quote, "yes," end quote, to seemingly innocent questions like, "can you hear me?" And then uses the recording of your voice saying yes in nefarious ways. Experts warn that natural speech technology is advancing so quickly that it may soon become impossible to tell if you're speaking with a human or a machine. So if you're receiving a call and the person on the other end asks, "can you hear me?" don't just say yes. Maybe just hang up. Remember, scammers constantly change their tactics, so always stay alert. And if you're interested in more about some of the cyber stuff, I did put out on the last podcast last week some helpful information in regards to cybersecurity. If you want to check out my last week's podcast, which was May 9th, you can check that out. But I'll try to keep this subject at top of mind throughout the year. There's a lot going on with cybersecurity and identity thieves, so we need to stay on top of it. Thank you for listening to the Northbound Wealth Podcast with your host, Brent Foster, CEO of Northbound Wealth Management. Please go out on social media, like and subscribe. Thank you for the support. And if you ever have any questions about personal finance, you can always reach out to us at 317-399-1107. That's 317-399-1107. Until next time, take care of yourself. Godspeed. We'll talk to you next week.